Hello and welcome to another episode of India Decides, the FI View with me, Tanveer Gill. This is a show that profiles global fund managers and their India view, also gets their emerging market view in the global context. My guest today on the show is Noriko Kuroki, who's Client Portfolio Manager, Emerging Market Equity Team at JPMorgan Asset Management. Noriko joins me from Singapore. Noriko, it's good to have you on the show. Thanks very much for taking out the time. Let me begin by understanding your EM outlook first. The emerging markets are currently trading at about 1.5 times price to book, which in your view historically has been a good entry point in EMs. The range, of course, being 1.5 times to 2.5 times on a price to book basis. Are you deploying more capital in emerging markets then at this point?
I think, as you mentioned, this is a good entry point for investors to get into emerging markets. The picture is still somewhat murky. We are not quite yet to see a clear bottoming out in earnings, but the value is definitely there. So our view is that this is a good time to gradually dip into emerging markets because we are hopeful that the long anticipated earnings recovery will gradually unfold in the second half.
Sure, but Noriko, how are you mapping recovery in earnings with growth this year in the U.S. disappointing, at least the Q1 numbers coming in worse than expected given the weather conditions there? There is, of course, the expectation that if, the process gets delayed in the U.S. and you're going to look at that delay, trickle down for emerging markets as well.
Yes. Suppose that the global economic recovery is one of the drivers for the overall recovery in emerging markets. But we actually think the gradual recovery in the U.S. is quite helpful because this also means that the monetary policy in the U.S. is going to remain supportive for some time. So what we actually don't want to perhaps see is a very strong recovery in the U.S. leading to rather perhaps premature tightening. So, gradual recovery for longer, we actually think is actually positive.
What does it mean then for your view on emerging market currencies? The rupee has gained about 11% from August 2013 lows. Do you think it's fairly valued now?
When we look at the EM currencies overall, we think the overall currency is fair to slightly cheap now. When you look at the long-term trend, essentially EM currencies have got rid of the so-called commodity boom benefits. So many of the commodity exporting currencies were very expensive, say 3 years ago. This is no longer the case. Specifically for India, rupee was sold off very aggressively last year. It has rebounded, but we actually think it still looks undervalued relative to the fair value.
Where are you allocating more capital within emerging markets? What's your India weightage right now? Because most funds traditionally benchmark India to the MSCI, which is around 6%. That's where the average weightage is. And would you look at reviewing that weightage that you currently have on India post-elections?
Yes. India has been a more favored market, especially post the sell-off. So we actually added to India during the post the sell-off in the third quarter last year. Currently, India is looking perhaps slightly more expensive than the EM average, but it still has a pretty good earnings momentum. So we are happy holders of the quality names we have in India.
Have you changed allocations from defensives to cyclicals as a sector theme as well, or is the conviction still with the defensives?
We actually been adding to discretionary names rather than staples within the consumer space, because when you look at valuations, staples have been quite expensive, discretionaries are cheap. Staples actually have underperformed to a degree over the past 12 months, but staples still look relatively expensive, so we actually favor discretionaries like auto names, for example.
Right, then which sectors within cyclicals are you most bullish on at this point?
So there are two sectors that we are positive. One is consumer discretionary, the other is IT. And here in India we own some of the IT outsourcing names. It's not actually short-term core. We are long-term investors, and what we think is attractive is that this global IT outsourcing is a long-term trend, still at an early stage. So we expect these companies to deliver good earnings for a long period of time.
Right. Before I talk about your India view, just wanted to get a sense of what your view is on the U.S. right now. That the labor market is improving, but the overall workforce is under pressure. Q1 GDP numbers, like I just pointed out, were worse than what the Street was expecting. European equities have been doing well, but the recovery is still not clear in the region. How are funds, taking the whole EM versus DM trade forward? How are funds such as yourself viewing emerging markets in lieu of the rally in DM so far?
First of all, on the US, the short-term data perhaps looks a bit disappointing, but we've been talking about this weather effect. So we need to look through, I think, second quarter numbers as well to see how strong the recovery is. As I mentioned previously, the gradual recovery in US is actually quite supportive for emerging markets because what we don't want to see is the repetition of the so-called tapering effect, i.e. Very aggressive tightening by the Fed. That's negative. So the gradual recovery in US we think is intact, and we think that's actually a long-term positive. As for Europe, I think it's perhaps too optimistic to assume a European economy can stage a strong recovery over, the next, say, 3 to 6 months, because there are lots of structural problems in Europe. But the point is that many of the weaker economies are gradually moving from the negative growth rate into the positive territory. So that's a huge, change. And the stronger European economy is actually supporting some of the emerging markets in Eastern Europe or even Turkey. So perhaps market was getting too excited about the recovery. We saw pretty significant re-rating in European equities last year, but market never goes up in a straight line. There are always short-term ups and downs. So we think, again, here the gradual recovery is intact, and that's also actually supportive for equity markets globally.
Right. Noriko, do you think emerging markets could see a cyclical rally in the second half of 2014, as was the expectation at the start of this year?
That is subject to, I think, a couple of external factors. First of all, absence of negative news headlines. I don't have to mention about Russia and the Ukraine situation, because this has been a recurring theme pretty much every week. So if you don't have any significant negative headwinds, and if the long-awaited recovery in earnings, this becomes visible, that is a possibility. But our base case is we as a long-term investor, we want to be conservative. So our base case is that we are going to see gradual recovery in earnings.
Let's discuss your India outlook then. What is the view on India compared to other emerging markets at this point?
Yes, when we analyze companies, we look at 3 key criteria: economics, duration, and governance. And in India, we find a lot of high-quality names fitting into these economics, duration, and governance criteria, i.e. companies with high return on equity, good duration meaning long, we can expect a long period of growth, and finally governance, private sector management whose interest is aligned with the minority shareholders. So we like India from the bottom-up stock selection perspective, because we kind of find they're the kind of companies that we think are suitable for long-term investment. Looking at valuations, India has been always a more expensive market than the overall emerging markets. So it's a question of how much premium you want to pay for that quality. During the sell-off in third quarter last year, this premium has come to pretty much negligible level. So we added to quite a number of names during this period. Since then, India has rebounded strongly, but we think that the valuation is not that stretched. So we are happy holders. Perhaps not the time to aggressively add like third quarter last year, but balancing the valuation and the quality, we think India is still a very attractive market for us.
Noriko, on price to earnings and price to book, does India still look attractive given that price to earnings is about 15 times FY15 earnings? You know, at the peak of 2009, India was at 22 times plus as far as PE multiples were concerned. I think it was a bit higher than that as well. Can the market post-election get re-rated to that extent?
Yes, I think a lot perhaps depends on the actual outcome of the elections, because there are a lot of optimism out there. And we think it's always dangerous to so-called bet on elections, because we can't really predict politics, and we think it's as an investor, our focus is more on companies' earnings and what will be the long-term growth that we can expect from a company, rather than betting on how many seats this party can get or the other. There are also sometimes rooms for disappointments when the expectations are too high. But having said that, if we can see a strong government out of this election with a clear reform agenda, perhaps some milestones, priorities clearly specified, that would be a very strong investment case for India, because as we all know, in India there are lots of potentials: infrastructure, consumers, how to leverage on the demographic dividends. It's got very young and growing populations, so how to capture on these growth opportunities. There are plenty of opportunities.
Noriko, let's discuss your sector view then, as far as India is concerned. What do you make of the earnings season in India that we have just seen for FY14, and the commentary that's come in on guidance for FY15 that companies have given out?
So far, earnings season seems to be going relatively well. I don't think there have been any major surprise one way or the other. Now, going into next year, there are still uncertainties about the level of recovery in the global economies, or perhaps more importantly, the election and the momentum of the domestic economy afterwards. So I think it's prudent that the companies are providing reasonably cautious guidance, and we need to kind of see exactly what sort of growth we can expect into next year. Perhaps that would become more visible in the second half of this year.
Do you still like IT companies in India? Where's the tilt? Is it more towards large cap ITs or mid cap ITs? Do you have a concentrated portfolio when it comes to the Indian IT space?
Yeah, IT sector has done very well, and we own a couple of names in this sector, and despite the strong performance, we are still happy with the companies that we hold, mainly tilted towards the larger cap names at the moment, because we don't think that relative to the growth we can expect from these companies over 5+ years, the valuation we are paying doesn't look that excessive. If valuation becomes more stretched, perhaps we might start thinking about taking some profit, but for the time being, we are happy with the current valuations.
FMCG companies in India, Noriko, are seeing volume growth concerns. Is the view on consumer companies in India still strong, the likes of HUL particularly?
Yeah, staple names, we are not so exposed to staple names right now, partly because we had concerns about valuations, and even after the period of underperformance, valuation doesn't look as compelling as we'd like them to be. But having said that, consumer sector in India clearly offers a long-term growth opportunities. So if you're going to see further correction in the share price because of the short-term margin pressure that they are seeing, we will probably look to add to some of the high-quality names there. There are many actually well-managed companies in the space, but given the weakness in the consumption, and also they suffered from weaker currency to a degree, which led to the margin compression. This will be gradually fading. So we think that they can see earnings bottoming up sometime, perhaps this year.
Also pharma, because that's the other defensive. So we've spoken about IT, we've spoken about FMCG. Pharmaceutical companies have been doing well as well. What kind of business model do you like in the pharmaceutical space in India and also world over? You know, where is the value in pharmaceuticals? In generics, in research-oriented companies, active pharmaceutical ingredients, that's APIs? Where is it that you think there is still more upside?
Yeah, this is an interesting sector that we are doing actually more work on. So we don't currently have any holdings, but given the recent acquisition announcements and realignments within the industry, we are doing more research on the sector.
What about cyclicals in India? Which sectors do you like most within that basket? You have capital goods, power, metals, autos, auto ancillaries. All of them have had their days under the sun where they've seen a decent rally. What do you like among these?
We have preference for consumption driven cyclicals as opposed to commodity price driven cyclicals, because commodity prices are inherently volatile, and we as a team have a relatively cautious view on commodity prices. So within the cyclical space, we like consumer discretionary, such as auto names. So we own a couple of names there, and they can benefit from the eventual recovery in consumption in India, for example. Other areas, perhaps in some of the industrial names that can benefit from hopefully better infrastructure spending environment post the election. We all know that infrastructure deficiency in India is a problem. So this is again another area where we can expect strong earnings for a long period of time.
Specifically, what's your view on Indian banks then?
We like Indian private sector banks. In the HDFC group, we've been a holder of HDFC for many, many years. We think that this is a very well managed company, and we have high confidence in the management, and they continue to gain market shares from the state-owned banks. And they generate a very high return on equity. So yes, Indian banks are more expensive than the other banks within emerging markets, but we think that they deserve their premium.
Final question then, Noriko. Do you think that with the new government, public sector companies could get re-rated, because we've seen a rally in those companies in anticipation of favorable policy measures?
Yes, perhaps a better public spending environment would benefit some companies, but as a long-term holder, we would rather see the kind of the alignment of the interest between minority shareholders and majority shareholders. So for state-owned entities, what we want to see is their interests clearly aligned with ours rather than them working for the state. That would be more, I think, more important factor to consider for us.
Noriko, thanks very much for joining us and giving us your perspective on the market. Really appreciate your time and views. So with that, we come to the end of this edition of India Decides, the FI View with Meet and Veer Gill. It's an all-important week as we step into election results. So catch you with another special guest next week. Till then, take care.